So we have yet another friend from Seeking Alpha, and I'll call him Mr. DS in case I butcher his name. But anyway, in this article specifically, he's essentially arguing or putting forth the argument that Alibaba's initial surge in share price since the late of last year is probably going to lose some steam. And let's go through what he has to say. But before that, always remember to gently tap that cute little like button. Before we go into the specifics of the article, let's take a look at Mr. DS's track record before we even say anything. So he has been putting forth many write-ups about Alibaba, and you can see that there is at least 9 articles here. And in his initial 4 articles, they were all sell calls, and in the remaining 5 or 6 articles, it's actually all hold calls. So you can see, essentially, when Alibaba was nosediving until $60 odd, he still gave the whole call, and even now, after rallying around 100%, he still provided a whole call. So let's look into what he has to say. New year, new sign-up rewards. So Weeboo's new welcome deal for the start of 2023 has never been better. So you can get up to $150 trading vouchers if you fund and trade your Weeboo account today. So all you have to do is to sign up for a new account with the link below and deposit at least 2,000 Singapore dollars and execute one buy trade on a stock or ETF and one mutual fund, coupled with buying one option, and you will get to enjoy a whopping 10.5% return on initial capital. So for those of you who are still considering sitting on the sidelines, I don't know what's holding you back. So when the markets are slowly selling down and S&P 500 just keep grinding downwards, I think it's a good opportunity to start dollar cost averaging into the markets. And you can even get an additional $150 to do so. So Weeboo prides itself on zero commission trading, and you can stop paying all the redundant commissions and use it to buy more shares. So recently, they've also allowed for a zero fee subscription and redemption of mutual funds on their platform. So don't let this opportunity slip away so easily. Link to sign up is in the description box down below. Thank you Weeboo for sponsoring this video. So Alibaba stock has become one of the main drivers of the Chinese stock market, returning 35.6% since December 30th, 2022. In global terms, I would like to draw investors' attention once again to the risks that have faded into the background. And I think you guys have to keep it at the back of your mind of this highlighted point, because I think this is extremely important and we'll discuss further why. So the initial phase of the rally in Chinese equities is almost done, and I don't know who determined this, but I guess it's him. Hedge fund positioning seems to be consistent with this view. So in my opinion, Alibaba stock is more likely to fall in case of capital outflows from Chinese stocks. Now, let's look at his entire argument in totality. Since the beginning of 2023, the theme of China reopening has attracted many investors to Chinese stocks. The iShares MSCI China ETF is already up 12.5% year to date. And this is the ETF, by the way, it's not individual names. So Alibaba, which is 9.46% of this ETF, has become one of the main drivers of the Chinese stock market. So in all the time that I've been writing on Seeking Alpha, I've written 9 articles on Alibaba stock. So at first I was bearish, then my tone changed to neutral. So if I'm not wrong, many of his articles were written within the time period of, say, probably 12 to 18 months, maximum 24 months. So short-term performance don't mean anything. So he's essentially trying to toot his own horn here. Just be aware of that. So after such an aggressive bull run that we have seen in the incomplete first month of 2023, I would like to draw the attention of potential investors once again on the risks that I believe many have begun to suppress. So new rally, old tricks. One major issue is still the VIE structure used by many Chinese companies, including Alibaba. So this structure allows foreign investors to invest in a company operating in China in a restricted industry, such as tech or media, through a contract rather than as an owner. So he has also increasingly noticed that investors have started to talk less about it, and the narrative has changed towards reopening. So even if you are willing to pay, not for the company itself, but for a contract from an intermediary company, how sure are you that the financial data on the paper is true? However, it still needs to be borne in mind that China companies are not subject to the same level of regulatory oversight and disclosure requirements as companies listed on exchanges in developed markets such as the US or Europe. So let me just bring you back in time. When Alibaba just listed in the American exchange, and that was all the way back in 2014. So that's at least a good 9 years now. So after a prolonged decade, we are back to this discussion of a VIE structure again. So it's quite interesting to see how many of these narratives develop over time. Because back then, when China companies actually list on the US exchange, most of them are under this VIE structure. And back in 2014, I'm sure there is a fair deal or a fair amount of skeptics on the other side of the lane saying that, oh, why are you investing in Chinese companies? You're just buying a contract, and you're not really buying into the company per se. And back then, when everyone was earning money, I don't see people complaining about, oh, it's a VIE structure. And when investors start losing money, they start pointing their fingers and saying that, oh, the Chinese government is out here to scam me. It's quite interesting, isn't it? Generally, when investors make money on the investment, it's all their credit. And whenever they lose money, it's always somebody's fault. And on the second part about how sure are you that the financial data on paper is true, that's why there is the HFCA Act, which is Holding Foreign Companies Accountable Act. And it's instituted by President Trump. It's still in due process of trying to iron out many of the kinks and nuances. As long as the PBOC gives the stamp of approval, then I think this risk is minimized to a large extent. But I'd just like to echo whatever Mr. DS has to say here. Don't forget it's still under a VIE structure, and don't forget about that when you are green on your investments specifically. Don't just point out the VIE structure when you're losing money. That's that. So another reason to be cautious about investing in Chinese stocks, including Alibaba, is the increasing authoritarianism of Chinese president. So I like the way Michael Green from Simplify Asset Management described the potential consequences of the political movement that has gripped China since it began consolidating power. So my take on China, and I've argued this for a while now, is that China operated under a very simple principle. You don't protest, we will make you rich. And the minute you can no longer make people rich, you can't actually rely on that. And so you have to stop them from protesting in a different way. To me, what's transpiring in China is a very simple reflection of what is called the political J-curve, right? Where you migrate to stability. There are really only two forces, two places of stability. You either have an incredible successful society in which people are broadly so happy that nobody really wants to get particularly worked up and disrupted, with some exception as the United States. The second form of incredible stability is effectively North Korea. And so China, while we had hoped that they were going to migrate towards us, instead is clearly migrating back towards North Korea. I'd just like to provide some very superficial commentary in this case because I don't profess to be a political expert here, but I don't think you can essentially squeeze an entire country's ideology, especially a huge nation in this case with 1.4 billion, 1.3 billion people, depending on which expert you ask, into just a very simple principle. You don't protest, we will make you rich. I think it's a lot more nuanced, a lot more complicated, and a lot more profound than this. That's my first point. The second point is everybody always like to talk in either extremes. So it's either you're capitalistic or you're not capitalistic. So the government is either authoritarian or it's not. So you're either a liberal democracy or you're not. What happened to all the different shades of grey in the middle? I really don't understand many of these political commentaries on the side. They always like to take a extreme position and say that, oh, because China is not walking towards the US, it's basically siding North Korea. So I completely and categorically disagree with his assessment of China today, and which is why I still remain extra bullish on China and why I still remain invested. So why does investing in China always box down back to the CCP, to the Chinese government, etc.? I don't really see people discussing about Singapore politics when talking about Singapore stocks in this case, but beats me. Truth be told, because it's the easiest way to discredit any argument. Because in politics, there's really no right answer. No one is your enemy forever, as long as our interest is aligned. So I tend not to put too much emphasis on the entire political discussion, but it's good to read up and to stay abreast of many of these developments. So the new geopolitical reality in which we are living for some years is bipolar. The deglobalization process are forcing Western countries to seek independence from its Eastern partners. As I see it, China is trying to sit on two chairs. So this is a dangerous game that many have lost sight of. Again, the issue of reopening and its influence today is enormous. So I'd just like to plant my flag here and say that a lot of these discussions around deglobalization, around a bipolar world, it's true that the trend is moving towards that trajectory, but honestly, I don't see a decoupling of the world. The West relies on the East, or in this case China, and China relies on the West as well. So I'll still be on YouTube. Many of you who leave distasteful comments here will probably still be on YouTube. and let time play it out and see who's on the right side of the curve. But I like my odds here. Globally, however, I believe China is opposing America both politically and economically, and is trying to wrest dominance from it. Therefore, I feel that Western investors are betting against America by supporting Chinese capital markets. Buying stocks is one of the way of doing so, and even Warren Buffett would not approve of such behavior. For 240 years, it's been a terrible mistake to bet against America, and now is no time to start. It's quite interesting, you see. Many people like to use this kind of argument. And honestly speaking, when I saw this paragraph, I immediately discredit Mr. DS, because all he's trying to do here is try to incite some sort of emotional gyration and saying that, oh, just because you invest in China, that's why you're betting against America. And for many Western supporters or many Western investors, it immediately clicks, because it's always a us versus them kind of argument. And just because you allocate your capital in the Chinese market, you're betting against America and you're being a traitor and yada yada. And that's how they extrapolate the emotion. And when you start bringing in emotions into the entire investing game, you probably lost half the battle. And funny enough, Warren Buffett himself has several investments in China as well. So even his right-hand man, Mr. Charlie Munger, has investments specifically in Alibaba and also in China via the Lilu Himalayan Fund. So are you trying to claim that Warren Buffett and Charlie Munger is betting against America? I think that's quite blasphemous. So by and large, I decided for myself a long time ago that I see no reason to invest in the Chinese economy despite low valuation multiple and growth potential because of two main reasons. A. Multiples can quickly lose relevance if your company is pressured by the state. B. Operational growth can easily be replaced by a steep crash with the click of a regulator fingers. So any of the above option is possible in any country. I mean, at least he's recognizing that fact, but China seems to me to have a higher chance of this happening. Sure, I think we will disagree on that, but I can see why people have that kind of conclusion. Okay, what about Baba? So I remain neutral despite the above risks. Chinese consumers trapped in their homes during parts of the pandemic amassed more than $2.2 trillion in bank deposits last year, which should boost spending according to the Wall Street Journal. However, as noted by analysts in Morgan Stanley's Asia Pacific Quant Strategy team, so they tend to believe that the initial phase of the rally in Chinese equities is almost done. So the hedge fund positioning seems to be consistent with this view, as data for the first half of Jan shows that hedge funds have increased their short position in the financials, tech, and communication service sector by double-digit percentage. So the momentum is only visible to professional market participants. And as you can see, it does look like hedge funds are staying long on e-commerce and healthcare, but media and infotech were added to their short, in this case around 12 to 18% in January month to date. I'm not too sure what kind of data or what kind of positioning they're talking about here, but I'd just like to point out a very interesting observation here whenever people like to cite statistics. So when people talk about active investing, many index investors or market participants like to cite this, I think, market research article on saying that how 90 or 99% of all actively managed funds tend to lose or tend to underperform the market. But interestingly enough, many of these hedge funds are also called smart money in this case. And people always like to cherry pick their arguments. So in this case, when it does support your argument or your narrative that, hey, China is going to underperform or China is going to experience a sell down soon, then look at how the hedge funds are positioning. They're essentially rotating out, or they're essentially trying to short the market now. So you guys better listen to them. And on a long-term basis, how many of these hedge funds tend to underperform the market? Let's just keep quiet about it. So all of us have our own unique perspective and narrative in our head in how the market is going to play out in the short, medium, and long term. So what you have to do as a viewer is to really be cognizant about many of the different biases and what's the narrative that they're trying to push forth. Because many of us like to cherry pick our arguments, and whatever supports our narrative, it will be at the top of our discussion or top of our argument. And you just have to be careful about that. Baba has grown more than all Chinese large caps. I showed that above. Baba has only 2.16% of all stock outstanding sold short, still quite low. Second, we cannot ignore the seasonal factor. Since its IPO 14 years ago, Baba stock has struggled to grow in Feb, March, Sep, and December. In its worst month of the year, December, Baba fell nearly 80% of the time, with an average decline of negative 6.6% month-on-month. Seasonality has expired but not disappeared. So if the first wave of stock growth is indeed behind us, Baba will most likely see a decline in Feb and March, which is very close. It's quite interesting. People are essentially trying to extrapolate, saying that, because in the last 14 years since its IPO, Feb, March, Sep, and December has been the worst months, so Alibaba will underperform in the following Feb and March. And in this case, if you look back for December alone in 2022, it has been one of the greatest rebound we have seen for Alibaba stock price. So let's not look into many of this voodoo magic, and I honestly don't know what's the basis of his discussion. Just because it happened 14 years ago, and I don't know, man. I don't know why people even believe in this kind of price action, but that's that. If you do believe in it, kudos to you, but I don't. So the third moment that can indicate a depletion of demand for BABA is the RSI divergence on the daily chart. Okay, we're going to go into the technicals. I'm not going to waste time there. So the fourth point to pay attention is the nature of valuation multiples. So if you look at a non-GAAP price to earnings ratio, it seems quite low, only at 15 times, which is the lower bound of the historical norm for BABA stock. However, this forward multiple should become a trailing 12-month one once the company shows astronomical recovery that is already priced in. So whether it's priced in or not, I'll leave it up to you to decide. But like he suggested, it's still at the lower bound of the historical norm of BABA, because BABA has always been trading more like a tech company. Surprise, surprise, in case you didn't realize that BABA is a tech company. But they've essentially been trading, at the highs, when it was rallying hard in the last 5 odd years before the tech crackdown, it was at least around 25 to 30 times PE. So that's that. Now, the bottom line is this. In global terms, I would like to draw investors' attention once again to the risks that have faded into the background. And I agree. Remember, it's still a VIE structure. Even if you are green, remember, it's a VIE structure. So I suspect that many investors who bought BABA in recent months will want to take profit in the coming weeks. And I agree to that too. In fact, I believe people that actually got in the lows already took profit or already started taking profit. So this is consistent with seasonality, technical setups, and hedge fund positioning. The narrative of China opening up still sounds like a strong argument for BABA, but it's probably losing momentum already and may lead to weakness in the medium term. Low multipliers and reopening alone are not enough to risk your hard-earned money. I'd just like to say that whenever you put your hard-earned money into the capital market, you're already risking it, regardless of whether you buy Chinese stocks or whether you buy US big tech or whatever safe stocks, quote-unquote safe stocks out there. So I'll just plant my flag here and say that again. I think in 2023, the narrative of China reopening will be the center of attention. So it will go on until the second half of 2023. At least this is my own prediction. You can have your own opinion. So with that, I'll see you in the next video. But more importantly, I'll finally see you on the moon. Goodbye.